Hello and welcome to this video. In this video I would like to go into interest rates and the term structure. For this video I planned the following. I would like to go into some terminology and notation. I would like to introduce some discussion around the interest rate. I would like to show up how the term structure looks like. And I would like to introduce theories of the term structure. Then I would like to go into some interest rates, so definition of special interest rates. And last but not least, we go into an R project for retrieving the term structure information from Deutsche Bundesbank. Some terminology and notation first. So, in this course, we will call the principal, so the amount of money that we borrowed in a loan or the face value of a bond. This is what we call the principal, and we will write it with a capital X. The interest rate that we define as a fraction of the principal of a loan that will be charged as interest per unit of time will be denoted with a small cap r. Accordingly, both together, the interest, the amount of interest or the charge that is levied for borrowing money is of course x times r. This can also be called C as coupon, because a bond has some coupons, and with the coupons it is meant interest payments. We make a certain assumption at the beginning of this course. Later on we will look a little closer. First of all, we define all interest rate as annual interest rates, which means that the implicit time unit is once a year. So once a year we will have an interest payments. This is not necessarily the case. There can be twice or quarterly payments or whatsoever, but at the beginning we speak of annual interest rates. The outstanding debt after 1 year now can be calculated, and this is what we call compounding, so putting interest on top, compounding. D1 is the outstanding debt after 1 year. That's why we have the little index 1 here, and that is, of course, the principal, so the borrowed money, plus the interest that is levied on the principal for 1 year, so x times r. And of course we can use brackets, and we can simply multiply x times, and in brackets 1 plus r. Let us make a little example. Let us assume that you borrow some $5,000 at an annual interest rate of 7%. Now the question is, how much interest will you be charged after the first year? And what is the outstanding debt after 1 year? So how much will be the accumulated debt then? So let's put it into our notation. 5,000, that's the principal value of the loan, or the face value of the bond or whatsoever. So capital X is $5,000. And the interest rate is 7%. 7% we always write like 0.07. That is 7%. So 7 divided by 100. That's what percent stands for, right? So the 1 year interest is x times r. So we have $5,000 times 0.07, which is 7%, and that is 350 euro that you will have to pay as an interest payment after 1 year, or that will be put on top of your loan. So your total debt outstanding after 1 year is of course x plus brackets 1 plus r, and that is 5,000 times 1 plus 0.07, and that is 5,350. And as you see, 5,000 plus 350 is, of course, 5,350. That's compounding. We put the interest on top. In basic courses, the interest rate is always given. This is an advanced course, so we have to discuss where does the interest rate come from. And the interest rate is nothing else but a price that we find on the market. So the interest rate are determined by market activity. We have some suppliers, so we call them investors on capital markets. And of course we have some supply curve on this market. The higher the interest rate, the more supply will be there. So the higher amount will be supplied to the credit market. And of course we have demand, we have borrowers, those who need money. But of course at a very high interest rate we will have only low demand. At a very low interest rate we will have high demand, or a large amount will be demanded. We have to differentiate a bit because the capital market is not only one market, it is several markets. We will see later on that we have to differentiate by the term of the loan demanded. If we make a rough definition, we can define the money market as short-term loan market, so up to 1 year, and the bond market as the market for terms with more than 1 year. And the interest rate are thus prices that are negotiated on the capital market. But, of course, interest rates are also heavily influenced by actions of governments and central banks. So they are not completely under control of demand and supply, but there's also governments and central banks involved. Nevertheless, if we put that into some microeconomic model, like I did this down here, so we see a typical price where supply and demand intercept. We see the size of the credit market for a specific term, of course, and we see some market rate, so the price that is negotiated on the market. As I said, the bond market or the money market can be differentiated by the term of the credits that are traded there. So we see something like a term structure, a function of the loan term. Here we see on the x-axis the term. So how long do you want to borrow your money? If you want to borrow only money for 1 year, you are very close to this end. But if you're looking for a 30-year loan, you will find yourself somewhere here. And still we have the interest rate on the epsilon axis. So you will be charged a different interest rate if you borrow money for 5 years than if you borrow money for 3 months, or if you borrow money for 30 years. So we need a certain notation for that. We again use the small cap r, of course, but we put some brackets with t in there, so we put the term in. So as an example, R2 is the interest rate for a 2-year loan, but still it's an annual interest rate, so the interest rate that will be levied for 1 year, not for 2. A typical term structure with rates increasing, we see it here. It starts with a low interest rate and goes up. This is what we call a normal yield curve. Why is it a normal yield curve? Because we see it most of the time like this. A very rare situation is an inverted yield curve that starts at the low terms with a very high interest rate, but then goes down And there's also a situation within that is a flat yield curve. Those are situations where short-term credits and long-term loans are at the same, roughly at the same rates. These inverted yield curves are extremely rare, and they're considered to be a predictor of economic recessions. Of course, there's something in our notation we have to keep in mind, because it can be the case that we have something like future rates. For example, if we want to borrow money in 1 year for another 3 years. And we need some notation for that. So we can use the notation RT and T for an interest rate prevailing at time T, maybe in the future or maybe in the past, for a loan term T. So that's the loan term then. Well, in practice and in basic courses or basic modules at university, it is often assumed that the term structure is flat. In practice, this is nearly never the case, so we need to get used to this term structure idea, or to this term structure. It is still there. So if we don't do that, there will be arbitrageurs coming and do an arbitrage against us. So we will lose money. And that might end up in losses or even in our bankruptcy if other market players play against us. So keep in mind, there is a term structure, otherwise you lose money. Here we see a recent, not a perfectly new, but a recent term that I received from Bundesbank. At the moment, or even for some years now, we have the unusual situation that the term structure at the very low end starts in the negative area, or in the negative zone. So here is 0. This is new, and it's due to the policy of the ECB, or even to all central banks at the moment, that we have very, very low interest rates. It is not the usual situation, but currently we do have it. But we see it's a normal curve. It's still upwards sloping here. Now let's come to some theories of the term structure. Why do we see term structures like this? The first theory that I would like to introduce is Culbertson market segmentation hypothesis. Culbertson assumes that there is a differentiation, a segmentation of the market. From a model point of view, he differentiates between two different types of borrowers of bond. Those with a preference for the short-term bonds here, and those with a preference for the long-term bonds that are somewhere here. So this results into some segmentation, or in a division into two parts of the market. The group of investors that has larger financial resources are the investors at the short end of the curve. This is you can see that there's a lot more money traded, so obviously there are investors with larger financial resources. And of course, if they have larger financial resources, they will have greater impact on the prices. So if they will buy short-term bonds, the bond prices will rise, and accordingly, their implicit interest rates will go down. So their interest rates will decrease. And so in the short term, we will see low interest rates. The volatility, so that these interest rates go more up and down, we see it here, than in the long run, can also be explained with investors parking their money in short-term bonds when the economic activity is poor. And if the economic activity is good, they rather go into stocks than into bonds. So they take their money out again. And that can also explain that the inverted yield curve is a signal for an economic downturn then. On the other hand, those investors on the long hand understand their investment as a long-term investment, which makes the long-term end of the yield curve more stable. The first theory that I would like to introduce is Culbertson market segmentation hypothesis. Culbertson assumes that there is a differentiation, a segmentation of the market. From a model point of view, he differentiates between two different types of borrowers of bond. Those with a preference for the short-term bonds here, and those with a preference for the long-term bonds that are somewhere here. So this results into some segmentation or in a division into two parts of the market. The group of investors that has larger financial resources are the investors at the short end of the curve. This is you can see that there's a lot more money traded, so obviously there are investors with larger financial resources. And of course, if they have larger financial resources, they will have greater impact on the prices. So if they will buy short-term bonds, the bond prices will rise, and accordingly, their implicit interest rates will go down. So their interest rates will decrease. And so in the short term, we will see low interest rates. The volatility, so that these interest rates go more up and down, we see it here, than in the long run, can also be explained with investors parking their money in short-term bonds when the economic activity is poor, and if the economic activity is good, they rather go into stocks than into bonds, so they take their money out again. And that can also explain that the inverted yield curve is a signal for an economic downturn then. On the other hand, those investors on the long hand understand their investment as a long-term investment, which makes the long-term end of the yield curve more stable. The second theory that I would like to introduce for explaining the term structure is Fisher, Hicks, and Lutz's expectation hypothesis. Let me make some remarks before I go into that hypothesis. If you want to invest some money for 2 years, you have two options. The first option is to invest your money simply for 2 years at a 2-year rate. That's pretty straightforward. The second option is to invest it for 1 year at a 1-year rate, and then to invest it again for another year. But since you don't know the interest rate after 1 year, you can apply something like a forward rate. A forward rate is a rate that you will negotiate now, but that starts in 1 year and holds for another year. So investing for 1 year and then for another year at that forward rate is the second option. Of course, and now the expectation hypothesis comes into play. If you expect higher rates in the future, and if mainly all investors expect higher rates in the future, those forward rates will be negotiated higher. Since there is an arbitrage possibility between both options of investing, the forward rate and the 2-year rate always interact together. And accordingly, if all market participants or many market participants expect rates to climb, the yield curve will be upward sloping. So this expectation hypothesis, based on the expectation that in the future the interest rates will climb, that's the most widespread hypothesis nowadays. The third theory of the term structure that I would like to introduce is Hicks liquidity premium theory. The consideration made here is that there is a certain preference for liquidity. So actors don't like to invest too long because they want to get their money back quickly. They want to have liquid investments. So they have a liquidity preference. According to this theory, those actors will only be prepared to give up their liquidity if they receive a premium, if they receive more money for doing so. And this premium is paid via the higher interest rates. So, since the degree of liquidity of an investment usually falls with the increasing term, a corresponding interest premium is charged, and the length of the capital commitment period and the amount of the premium are thus positively correlated with each other. Last but not least, I would like to go into the preferred habitat hypothesis by Modigliani, Miller, and such. The preferred habitat hypothesis is a more generalized hypothesis. It states that the market for bonds is segmented by term structure and that bond market investors have certain preferences for these segments. According to the theory, bond market investors prefer to invest into a specific part of the term structure called their habitat. And the bond market investors require a premium to invest outside of this preferred habitat. The model is a bit more complicated. I don't want to go into depth with this, but this is a very much researched hypothesis, especially since Modigliani Miller is one of the Nobel laureates, so it is very well known. Before we now go into certain interest rates, we have yet completely excluded the risk structure. The risk structure that is made of the so-called credit spread that comes on top as a risk premium onto the yield curve. There's a lot of research done to research the determinants of the credit spreads. This research is called the credit spread puzzle. Puzzle means there is not sufficient research. We can't fully understand how credit spreads are composed. So, a credit spread is the difference between the yield or the internal rate of return of a risky bond and the yield of a quasi-risk-free benchmark with otherwise identical conditions. Typically a governmental bond here. Credit risk is often understood exclusively as the issuer risk of a corporate bond, since the credit spread originally served exclusively as a risk measure for the default risk of bonds. Since then, the spread of corporate bonds have been compared with those of risk-free government bonds and of government bonds of different countries with each other. Later, the credit risk was extended to all credit risks, even entire loan portfolios. As a credit risk, it is a measure of risk that contains expectations about the probability of default and the recovery rate from loan defaults. Bond and loans can therefore be considered as interest-bearing assets. If a German credit institution holds a foreign government bond in its portfolio, the credit spread is the difference between the yield on this bond and the yield on a government bond of the same maturity. While credit spreads are often generally understood as the compensation for credit risk, it has been difficult to explain the precise relationship between spreads and such risk. In 1997 to 2003, for example, the average spread on a BBB-rated corporate bond with 3 to 5 years to maturity was about 170 basis points at annual rates. Yet, during the same period, the average yearly loss from default amounted to only 20 basis points. In this case, the spread was more than 8 times the expected loss from default. The wide gap between spreads and expected default losses is what we call the credit spread puzzle. Now let's go into some specific interest rates and how they are derived. We start with the Libor. The Libor is an abbreviation for the London Interbank Offered Rate. It corresponds to the interest rate at which banks are prepared to lend to other banks for short-term loans. Libor is quoted in 5 currencies: the US dollar, euro, Great Britain pound, Japanese yen, and Swiss franken, and for several maturities ranging from overnight to 1 year. It is currently administered by Intercontinental Exchange. Due to abuse during the financial crisis years, replacements for Libor have been developed, and the central role of Libor may diminish in the future. Uribor stands for Euro Interbank Offered Rate. It is a reference interest rate for time deposits in euro in interbank business, calculated since 1st January of 1999 on bank working days for the maturities of 1 week, 2 weeks, 3 weeks, and the 12 monthly maturities from 1 month to 12 months. Since 1st November 2013, only the values of the maturities 1 week, 2 week, 1 month, 2, 3, 6, 9, and 12 months have been published. On business days, banking days of the Target 2 system apply here. 19 Uribor panel banks, including 2 German banks, currently report offered rates to the New Zealand company Global Rate Set System, which calculates the average rates by 10:45 a.m. Brussels time. Until 30th June 2014, this was done by information provider Thomson Reuters. The average rates are published on Reuters at 11 a.m. With 3 decimal places, see Reuters page Uribor 01 and Reuters RIC Uribor =. The 15% of the highest and 15% of the lowest reported interest rates are not included in the Uribor calculation. This should ensure that interest outliers do not distort the market. The interest calculation method actual 360 applies to the interest calculation. Eonia Euro overnight index average is the interest rate at which unsecured euro-denominated loans are granted on the euro area interbank market for one target day to the next. A target day is any day on which the target 2 system processes payments. The European Central Bank calculates the Eonia for 3 decimal places as a per annum interest rate using the actually 360 interest rate calculation method. In future, the Eonia is to be gradually replaced by the Eurostir, Euro short-term rate. The ECB will publish the Eurostir from 2nd October 2019 onwards. Now I would like to go into an R case. So we are going to try to receive some yield curve data from Deutsche Bundesbank. In this video, I will not go into calculation methods, so how to derive the yield curve. I will do that in a later video. I'm now in RStudio, and I just opened up this beautiful little script window and I start my scripting. Here I've already given it a headline: retrieve yield curve data from Deutsche Bundesbank, first case. The first thing that we need to have is the Bundesbank package, which is used to retrieve data from Deutsche Bundesbank. So I use install.packages, and the name of that package is Bundesbank. And I just run this one, sorry. And a few seconds later, this package is installed. Since I only have to do this once in a lifetime of this R installation, I can now write if not yet done, because if I later use the script again on this computer, the Bundesbank package will be still installed. But I need to run this package with a library command. And I run it and no error message, so the Bundesbank package is now started. The first thing that I need to define is the name of the series, so I need to have the name that the Bundesbank gave a certain time series. Define the time series to download. Here the 3-month interest rate. So I give it a variable, and the variable I will call simply series. And I just put the string in. It's a bbk01.st0316. Now we can download the time series into some list. So download time series into list. So a list is always started with LST, so I like to have it like that. List like Bundesbank data, and we apply the get series command that comes with the package Bundesbank. And of course we need now this name that we have stored into the variable series. So I just write var series. Then we need a start date. Start is here, let's say 2012 January. And an end date. That is here. Today is October 2020, so 2020-09, last month, that will do. Okay, I just run this. Oh, I forgot to run the first line here. Now I run both. Downloading data from Bundesbank done, that's very good. And now we can have a look. On our right hand side in our environment, we now see the list. I can double click the list, and here we see the dates on the left side and the values on the right side. So very beautiful. We can convert that into a data frame. So we need now a df data frame. Like that, I don't know. A data.frame command. And we put the list in there and run this line. Now it is converted, and we can take a look at that data frame. And we see down here the output looks mainly the same than from the list. And of course, what we can do with it is plotting it. And I'd try to do a beautiful but standard plot, of course. So plot df view bar data. I can run it like that. Then it looks ugly like we see it here. We can make it more beautiful. So for example, we give a type is L. L stands for line plot. Then we give it a main headline. The main headline is 3 month Uribor. We give it an xlab. That is date. We give it an epsilon lab label, right? That is Uribor in percent. I just set the LWD parameter and I give it the color that should be blue, and rerun that, and there it is. Let's zoom it. Here is the time series of the 3-month Uribor between 2012 and 2020. So, of course, this is just one interest rate, the 3-month Uribor, but of course we could be interested into some yield curve, right? I already prepared some data for that, like here. It's a bit more work to do. Nevertheless, we start with installing those packages from Bundesbank, but we then apply the XTS package. Here is a bit more advanced XTS package. It only installs that package if it is not yet installed. Then we run the XTS package, and now we put all those names from all those interest rate into variables. Where do I have those names from, by the way? So here's Google. I go to Bundesbank. I will find some, is it statistics? Just to have a look. Time series database. Money and capital markets. No, we need to go into interest rate and yields. And here we see money market daily values. And here we see all those numbers: euro short-term rate, money market, 1 month, money market 3 month, and so on. So this was the one that we saw earlier, right? Okay, so here we get all that. We can also retrieve a CSV, so a readable for Excel here. Here's the same in Excel, and of course we don't see values for the weekends, but we can also have it in Microsoft Excel here. Okay, so let's store them into variables. And now let's get all those time series. And next block here, let's convert them into XTS. So I run this. It takes a few seconds. Now we have many XTS objects. We can look into one of them. It's just like a data frame, but for time series. And XTS have those beautiful dates on the left-hand side. And now we merge all those XTS into one big XTS. So it's just one line. Let's run this line. It's already done. We remove several of those variables. Now we just cleaned up our environment here, and now we can plot something. So here it is. Here we see all the time series in one picture, the long-term one and the short-term one, all of them in one picture. But of course we can also plot one of those lines, picking it out. And that's a beautiful plot. That's a lot more beautiful than we usually see using normal plots, because it's an XTS, and XTS comes with plots on its own. We now make a vector of maturities, and now we plot a yield curve that has these maturities. And that's good, isn't it? So here we have the yield curve that we saw earlier in our video. Here I just played a little. So I made a data field for the yield curve and plotted with individual dots. And now we can combine those dots to a new curve. That doesn't really make a sense, because Deutsche Bundesbank has already applied some flattening measures. They use the Svensson regression here, and we already see a very beautiful curve here. But we can also apply cubic spline interpolation to make lines on these curves, and that's the beautiful idea. We can then apply it as a function. So here we define a function, yield curve cubic spline, and we make a spline function with a certain method. We don't go into that here. Now we have a function, and now we apply this function on a certain sequence, and we plot that function. And here we see many dots. All those dots were given. It's a sequence between 0.5 and 30 years with 0.25 years distance between all plots. And here we now plot that whole sequence, and this is what we see here. So we can also calculate individual interest rates for 3.5 years, 3.75 years, and so on, or even 3.6 years, because we have this function which is based on a cubic spline interpolation curve, and we can interpolate those individual interest rates. Okay, that was it. Thank you for watching this video. See you in the next video, and don't forget to like my channel and to put a thumb up on my video.